Usually when we talk about like a medical diagnosis, there is this expectation of absolute precision. It's almost like engineering.
Oh, absolutely. It's binary.
Right. You fall, you break your arm, the x-ray shows that jagged white line right across the bone, and the doctor just points at it and says, there it is. That's the problem.
Broken or not broken, you put a cast on it and you know exactly how it's going to heal. I mean, we naturally gravitate toward things that can be easily categorized like that.
It's comforting.
Yeah.
But then you step into other realms like neurodevelopment or complex trauma, and suddenly that x-ray machine is completely useless. You find yourself looking at a diagnostic landscape that is just entirely murky. You have to look at the symptoms, the history, the environment, and try to piece together a narrative that actually makes sense. Well, today, we are looking at a different kind of x-ray for you. We are examining the anatomy of a financial and industrial resurrection that is so massive and honestly so structurally complex that it completely defies traditional categorization. So welcome to Griffonomics. This is our special series here on the Deep Dive, and today we are putting the diagnostic machine directly over Westinghouse Electric Company.
And what we are seeing on that film, as we hold it up to the light, is nothing short of historic. We are analyzing a company that is meticulously plotting its return to the public markets. Through a highly confidential IPO filing, Westinghouse is targeting a jaw-dropping, and I mean jaw-dropping, $30 billion plus enterprise valuation.
$30 billion. I really want you, listening right now, to just let that number sink in for a second. Because we are talking about a company that, not even a decade ago, was the absolute poster child for catastrophic, earth-shattering industrial failure. So here's our mission for you today. We are going to deconstruct the mechanics behind what is arguably the most pivotal equity listing of the 2026 nuclear renaissance. We are essentially pulling back the curtain on a massive financial secret.
Right. And to accomplish this, we are synthesizing an extensive stack of highly confidential source material. We've parsed their Form S-1 filings. We are breaking down Cameco's Q2 2026 management's discussion and analysis. We are examining deeply technical architecture blueprints for their next-generation reactors. And we are layering all of that over rigorous forensic financial analyses of their entire capital cycle.
Okay, let's unpack this. Because any rational person has to ask, how does a heavy industrial company go from complete bankruptcy to a $30 billion valuation in under a decade? I mean, this sounds like financial alchemy. So to understand this, we have to trace the forensic steps of this extraordinary capital cycle. We need to go all the way back to the collapse.
Yeah. If we look at March 2017, that is when Westinghouse filed for Chapter 11 bankruptcy protection. And this wasn't just a, quiet corporate restructuring. It sent absolute shockwaves through the global energy sector and international financial markets. To grasp why it failed so spectacularly, we really have to look at the business model they were shackled to at the time. Westinghouse, which was owned by the Japanese conglomerate Toshiba, had locked itself into what are known as fixed-price engineering, procurement, and construction contracts.
Wait, EPC contracts, right?
Yeah. In the industry, they just call them EPC contracts.
Let me jump in here, because in the heavy construction world, and especially the nuclear construction world, where you are dealing with literal atomic physics and immense regulatory oversight, a fixed-price EPC contract seems like a financial suicide pact if the wind blows the wrong way.
That is an incredibly accurate way to describe it. Under a fixed-price EPC, the contractor, in this case Westinghouse, promises to design the plant, buy all the materials, and build the entire facility for one single guaranteed price. And they were contracted to build 4 of their massive AP1000 reactors in the United States. 2 were at the Volatile plant in Georgia, and 2 were at the VC Summer plant in South Carolina.
So the utility companies basically said, we will pay you X billion dollars, and if it costs you more than that to build, that's your problem, not ours.
Precisely the dynamic. And you have to remember the context of the mid-2010s here. These were first-of-a-kind deployments in the United States for this specific reactor design. Westinghouse attempted to innovate by using modular construction. The theory was sound, right? Build giant, multi-ton pieces of the nuclear plant in off-site factories where you can control the environment, ship them to Georgia and South Carolina, and assemble them like giant Lido bricks.
The theory is sound, sure. But reality has a way of ruining good theories. From what I've read in the forensic audits of this era, the execution was just an absolute nightmare.
Oh, it was a cascading failure. The modules arrived at the sites and they literally did not fit together.
You're kidding.
No, I mean, the rebar was wrong, the documentation was incomplete, and because this is nuclear construction, you can't just take a blowtorch and force it to fit.
Right, you can't just wing it.
Exactly. You have to stop work, submit hundreds of pages of engineering revisions to the Nuclear Regulatory Commission, wait for approval, and try again. All the while, you have thousands of highly paid workers standing around idle on the job site.
And every single day of delay is eating directly into Westinghouse's profit margin because, again, it's a fixed price contract.
Yeah.
They're eating the cost of those idle workers.
Right. The delays compounded exponentially, and the cost overruns balloon into the tens of billions of dollars. It was a financial hemorrhage of historic proportions. It didn't just push Westinghouse into Chapter 11, it actually brought Toshiba, one of the most storied conglomerates in Japan, to the brink of total collapse.
Wow.
Yeah, Toshiba had purchased Westinghouse back in 2006 for $5.4 billion, viewing it as the crown jewel that would dominate the global nuclear renaissance. 11 years later, Toshiba was taking multi-billion-dollar write-downs and desperately trying to carve Westinghouse out just to survive the fallout.
It's a staggering reversal of fortune. So Westinghouse is languishing in Chapter 11. The VC summer project in South Carolina gets completely abandoned. Like, they literally just stop building it, leaving a multi-billion-dollar concrete monument to failure sitting in the dirt. Vudel pushes forward, but at a staggering, eye-watering cost to the utilities. At this point, Westinghouse is practically financially radioactive. No traditional investor wants to touch a company holding that kind of liability. But then we see the classic private equity rescue.
Enter Brookfield Business Partners, operating under the ticker BBU. In 2018, they stepped into this void. Brookfield has built a formidable reputation for acquiring distressed, highly complex, deeply out-of-favor industrial assets. And they purchased Westinghouse out of bankruptcy for $4.6 billion.
I have to ask, what did Brookfield see that everyone else missed? Because looking at the wreckage of VC Summer, most people just saw a bottomless money pit.
They saw the underlying intellectual property. Brookfield realized that underneath the catastrophic, crushing weight of those EPC construction liabilities, Westinghouse was still fundamentally a technology powerhouse.
Wow.
They owned the blueprints and the global patents for the AP1000 reactor. And crucially, they had a massive, quietly humming, highly profitable services business.
Oh, right. This is the fuel fabrication and maintenance arm, right?
Yes. Westinghouse provides the specialized nuclear fuel assemblies, the outage maintenance, and the engineering support for roughly 50% of the world's operating commercial nuclear fleet.
Half the world's fleet.
Exactly. That is recurring, sticky, high-margin revenue. So Brookfield's masterstroke was restructuring the business. They systematically stripped away the construction execution risk. They drew a hard line and pivoted operations to focus purely on what Westinghouse does best, designing the reactor technology, fabricating the atomic fuel, and servicing the existing global fleet.
So fast forward to late 2023. Brookfield has spent 5 years cleaning up the balance sheet, streamlining operations, and actually proving this new business model works. And they decide it is time to monetize this turnaround. This is where the recapitalization happens and the numbers start getting really, really big. In November 2023, they orchestrate a sale of Westinghouse at an enterprise value of $8.2 billion.
Right. And let's forensically audit that $8.2 billion figure, because understanding the capital stack here is vital for what comes later. That enterprise value included $3.8 billion in debt.
Okay.
If you strip that out, it leaves about $4.5 billion in net equity value. And the buyers were not just another private equity fund looking for a quick flip. It was a highly strategic consortium.
Walk us through who actually wrote the checks for that equity.
So Brookfield Renewable Partners, trading under the ticker BEP, took a 51% controlling stake. This is important because it kept Westinghouse within the broader Brookfield family ecosystem, but shifted it specifically into their massive clean energy investment vehicle. And the remaining 49% was acquired by Cameco Corporation, the Canadian uranium mining giant, trading under the ticker CCJ.
Before we move on to what Cameco is doing, I want to pause and appreciate the absolute masterclass in private equity returns that just happened here. BBU, the initial buyout arm, generated roughly $1.8 billion in net cash proceeds from this exit. In private equity terms, that is a 6x MOICA multiple on invested capital.
It's phenomenal. For those tracking the math, that means for every dollar of actual equity BBU put into the 2018 buyout, remembering they used debt to fund a large portion of the $4.6 billion purchase price, They got $6 back in 2023.
6 times their money on a bankrupt nuclear company that most of Wall Street had left for dead. That is legendary. But here's the massive question for you listening. That was 2023. They valued the entire company at $8.2 billion. Now, in 2026, we're looking at S-1 filings for an IPO targeting $25 to $35 billion.
Exactly. This is the valuation bridge we really need to forensically audit. How does any rational market justify a multiplier that takes an $8.2 billion asset and inflates it to roughly $30 billion in just under 3 years?
Well, let me push back on this valuation immediately, because if you look at Westinghouse's legacy operations, fuel fabrication and that recurring services business you mentioned, which supports half the global fleet, I would say that segment historically generates between $800 million and $1 billion in EBIT annually,
Right.
earnings before interest, taxes, depreciation, and amortization. Basically, their core cash flow.
Those figures are correct, yes.
Yeah. Okay. If they're pulling in $1 billion in EBITDA from servicing existing plants and selling metal rods full of uranium, a $30 billion valuation is insane. That is a 30x EBITDA multiple for a heavy industrial servicing company. That is software as a service territory. That's NVIDIA territory. It's like buying a steady, reliable local hardware store that sells hammers and nails, but you are paying the valuation of a hyper-growth tech startup. The math just does not compute.
What's fascinating here is that the math does not compute if you are only valuing the hardware store. Public equity investors lining up for this IPO are not paying $30 billion for a $1 billion servicing cash flow. They are entirely capitalizing the expectation of massive, unprecedented future reactor growth.
So they are buying the land the hardware store sits on, completely convinced there is a trillion-dollar gold mine underneath it.
Yes, but it's not gold. It's the transition from an asset-heavy construction liability into an asset-light intellectual property and licensing franchise. The market is pricing in the stark reality of the global grid.
Ah, they are pricing in the AI data center boom. We talk about it all the time here. The absolute desperate thirst from hyperscalers like Microsoft, Google, and Amazon for clean, 24/7, firm baseload power to run their gigawatt-scale training clusters. Because wind and solar are great, but they are intermittent. You can't run a multi-billion-dollar AI cluster on a power source that drops to zero when a cloud passes over or the wind dies down. You need firm power.
Right. And if we connect this to the bigger picture, Westinghouse is positioning itself as the undisputed toll collector on the only zero-carbon road that leads to firm gigawatt-scale power. That is what justifies the $30 billion multiple.
Which brings us to the governance of this newly minted behemoth. Because now that we understand the astronomical price tag, we have to look at who is actually holding the equity on the cap table and the staggering geopolitical strings attached to it. Let's talk about Cameco. They hold 49% of this company. Cameco is a massive player in the upstream uranium market. They mine the raw material out of the ground in Saskatchewan and Kazakhstan. Why on earth did a mining company buy almost half of a reactor designer?
It was a highly calculated play for ultimate vertical integration. Cameco wanted to combine their upstream uranium mining and refining capabilities with Westinghouse's downstream fuel assembly and reactor technology. They essentially wanted to own the entire nuclear life cycle.
That makes sense.
It does, but to execute this ambitious $2.1 billion equity check in 2023, Cameco had to lever up its balance sheet significantly. They took on about $1.5 billion in cash debt and another $600 million in term loans.
That is a heavy debt burden in a high-interest rate environment. So for Cameco, this upcoming IPO isn't just a victory lap to show off their smart investment. It is a vital deleveraging event.
Absolutely. The S-1 filing outlines a partial secondary float.
Let's define secondary float for the listener, just to be crystal clear on the mechanics.
Certainly. In a traditional primary IPO, a company issues brand new shares to the public, and the cash raised goes directly into the company's treasury to fund growth or operations. In a secondary float, existing shareholders like Cameco and Brookfield sell a slice of their currently owned shares to the public. The cash from that sale goes directly into the pockets of Cameco and Brookfield, not to Westinghouse.
So by floating a portion of their 49% stake in this $30 billion IPO, Cameco can monetize massive paper gains. They can take that cash, immediately pay down that $2.1 billion in debt they took on, and free up massive amounts of capital to fund their core upstream mining operations.
And this is where Cameco's strategy is truly a masterstroke. They get to deleverage and cash out a portion of their investment, all while having already secured their primary strategic goal. As part of the 2023 acquisition and partnership, Cameco locked in 28 million pounds of annual uranium supply commitments with Westinghouse all the way through 2030.
Wow, that is brilliant. They bought the company that buys their product, forced them to sign massive long-term contracts to buy their uranium, and now they're selling a piece of that company to the public at a massive premium to pay off the debt they used to buy it in the first place.
It is vertical integration financed by public market enthusiasm.
Yeah.
But as we analyze this cap table, a really complex geopolitical paradox emerges.
Right, because the actual financial ownership of Westinghouse is led by Canadians. Cameco is headquartered in Saskatchewan. Brookfield, despite being a global behemoth, has deep Canadian roots and headquarters in Toronto. Yet, when you look at Westinghouse's operations, its history, and its technology, it is a fundamentally American entity.
Yes, it is the geopolitical ownership paradox of the nuclear age. Westinghouse is capitalized by Canadian-led equity, but its operational reality, its lifeblood, and its most sensitive intellectual property exist entirely under United States jurisdiction. It operates under strict U.S. export controls. Its technology is governed, audited, and licensed by the U.S. Nuclear Regulatory Commission, the NRC.
And this tension leads us to the most incredible part of this entire S-1 filing. When I read this, I actually had to read the paragraph 3 times to make sure I wasn't misunderstanding it. The U.S. equity clawback. The United States government has essentially tethered itself to Westinghouse through an unprecedented financial mechanism.
It's wild. To understand the clawback, you really have to understand the macro policy context. The U.S. government has initiated an $80 billion domestic reactor build-out plan. They recognize that maintaining global leadership in AI requires massive amounts of domestic power. The federal government is actively facilitating financing, including utilizing complex co-funding mechanisms with sovereign capital from Japan to rebuild the hollowed-out domestic nuclear supply chain.
And because the federal government is throwing its massive sovereign weight and billions in facilitated financing behind Westinghouse, essentially anointing them as the chosen champion for this domestic energy security build-out, Washington demanded a piece of the upside.
Exactly. The federal government recognized that their policy support was directly responsible for a large portion of Westinghouse's future valuation. So they negotiated a contingent interest right.
Break down the exact terms of this contingent interest, because it is wild to see a sovereign government acting like a Silicon Valley venture capital firm negotiating a term sheet.
The U.S. government holds the right to claim up to a 20% equity stake in Westinghouse.
20%. That is a massive chunk of a $30 billion company.
It is, however, the structure is highly specific. When you adjust for the complex mechanics of warrants and the net dilution that would occur upon execution, it effectively translates to roughly an 8% final equity interest for the government. But there is a massive, highly specific condition attached to this clawback.
What's the catch?
The U.S. government only gets to exercise this equity right if Westinghouse successfully executes on these massive domestic reactor orders and officially achieves a public valuation of at least $30 billion before the year 2029.
It is literally a performance-based equity grant for Uncle Sam. Build the reactors, hit the valuation target, and we get 8% of the company.
It is a remarkable alignment of sovereign incentives and private capital. And looking objectively at the policy environment, this strategy crosses traditional political lines. If we examine the recent past, former President Donald Trump made distinct pledges to drastically slash regulatory red tape and invest tens of billions to rebuild the domestic reactor fleet, explicitly viewing nuclear dominance as essential to winning the global economic and AI race. Concurrently, if you look at the current landscape, U.S. Energy Secretary Chris Wright and the Department of Energy are actively viewing Westinghouse as the core anchor of domestic commercial nuclear energy security. They are pushing major federal policy directives to support its expansion.
So regardless of who sits in the Oval Office, the federal policy directives are designed to firmly anchor Westinghouse's strategic center of gravity in the United States, counterbalancing the Canadian equity ownership. What does this all mean for you, the listener, trying to make sense of this IPO? It means Washington is effectively treating Westinghouse as sovereign national security infrastructure. They're implicitly saying, we will use Wall Street's money through this massive IPO to fund the capitalization of our national energy security. But we are holding a massive financial trump card on the cap table to ensure the strategic value stays right here.
It is a brilliant, albeit complex, alignment of public policy, national security, and private capital markets, but we must ground this conversation in physical reality.
Right.
Financial engineering, brilliant cap table governance, and sovereign government backing only matter if the underlying technology actually works.
Exactly. You cannot power a gigawatt AI data center with a brilliant S-1 filing or a government warrant. You need concrete, thousands of tons of forged steel, and the reliable splitting of atoms. So let's pivot from the boardroom to the engineering bay. Let's perform a rigorous technical audit of Westinghouse's product stack.
This is where the valuation truly lives or dies. Westinghouse has structured its entire future around a core, three-tiered product architecture. We need to dissect each tier to understand the engineering advantages that the market is assigning such a premium to. Let's start at the top. Tier 1, the AP1000. This is their flagship, generation of the third, plus pressurized water reactor.
This is the absolute big boy. This is the design they finally managed to finish building at Vogtle. The specs on this machine are staggering. We are talking about a gross thermal output of 3,415 megawatts, which translates through the steam turbines into a net electric output of about 1,100 to 1,200 megawatts electric.
Yes. To put 1,100 megawatts electric into perspective, a single AP1000 provides enough continuous baseload power for hundreds of thousands of homes, or it can serve as the dedicated power supply for a very large, centralized cluster of hyperscale AI data centers. But the real selling point of the AP1000, the reason it is Generation 3 Plus, isn't just its massive scale. It is the fundamental architecture of its safety systems. It utilizes NRC-certified fully passive safety systems.
Passive safety. That has been the magic phrase in the nuclear industry ever since Fukushima. I read the descriptions, but I want to make sure I understand the physics. Explain how passive safety actually works in the AP1000, because it seems brilliant in its simplicity compared to older designs.
To understand passive safety, you have to look at the older Generation 2 reactors. In those older designs, if you lose off-site power to the plant, you desperately need giant backup diesel generators to kick on. Those generators provide electricity to massive mechanical pumps, which force cooling water over the reactor core to remove the decay heat and prevent a meltdown. That relies on active mechanical systems.
And active systems require power and moving parts. Moving parts break.
Exactly. Pumps can fail. Generators can flood, which is exactly what happened at Fukushima. The AP1000 eliminates that requirement entirely. Its core safety systems rely purely on the immutable laws of physics, gravity, natural circulation, and convection.
So let's walk through a worst-case scenario. The grid goes completely down, a hurricane wipes out the power lines, the plant loses all alternating current power, what the industry calls a station blackout. What happens inside the AP1000?
The moment power is lost, fail-safe valves, known as WIB valves, automatically blow open.
Wait, they open when the power drops?
Yes, they require power to stay closed, so when power drops, they open. Above the reactor core, inside the massive steel containment vessel, sits an enormous tank of cooling water.
And because the valves are open, gravity simply pulls that water down onto the core.
Correct. The water floods the reactor cavity. The immense decay heat from the nuclear fuel boils that water, turning it into steam. That steam rises to the top of the interior of the steel containment dome.
And here is where the genius of the shield building comes in. There is an air gap between the steel containment dome and the outer concrete shield building, right?
Yes. Natural air circulation pulls cooler air in from the bottom of the shield building, runs it up the outside of the steel dome, and vents it out the top. This cold air cools the steel dome. So when the steam inside hits the top of the steel dome, it immediately condenses back into liquid water.
And gravity pulls it right back down the walls into the tank to flow over the core again. It is a completely closed loop driven entirely by boiling, condensation, and gravity. No pumps, no diesel fuel, no human operators flipping switches in a panic.
It is elegant engineering. The Nuclear Regulatory Commission has rigorously tested and certified that this passive system provides 71+ hours of station blackout coping without any human intervention or external AC power whatsoever.
That's incredible.
It is. And beyond safety, the AP1000 boasts the smallest footprint per megawatt among any large pressurized water reactors globally. The nuclear island, which encompasses all the safety-critical portions of the plant, sits on just 3,015 square meters.
That is incredibly dense power generation. And I noticed in the specs that it's highly flexible. It has rapid load-following capabilities. My understanding is it can ramp its power output up or down by 5% per minute, going all the way down to 15% of total power without shutting off.
This actually raised eyebrows in the energy sector because traditional nuclear plants hate changing their output. They want to run at 100% all the time. But load following is crucial if you are integrating a massive nuclear plant into a grid that is heavily saturated with renewables like wind and solar, which fluctuate constantly.
Oh, sure.
Right. When the sun sets, the AP1000 can rapidly ramp up to fill the gap. Plus, Westinghouse has heavily optimized the maintenance cycles, achieving record-setting 19-day refueling outages. That means the plant is online, generating electricity, and making money for the utility more often than older designs.
Okay, that is Tier 1, the established operational giant. But as I read through the financial press, the market seems equally, if not more, excited about Tier 2, the AP300 small modular reactor.
The SMR market is the most heavily contested space in nuclear engineering right now.
Let me be a bit cynical for a second. Small modular reactor is the ultimate buzzword of the 2020s. Every week, there's a new startup with a slick website and a 3D rendering of an FMR, promising cheaper, faster nuclear power. But most of these companies were essentially building high-tech, unproven science projects from scratch. Why should we believe the AP300 is any different?
Your cynicism is entirely warranted. The AP300 is fundamentally different because of its lineage. The AP300 is designed to generate 330 megawatts electric from a 999 megawatt thermal one-loop system. The engineering genius of the AP300 is that it is not a new invention. It is a direct, highly deliberate scale-down of the AP1000. Westinghouse is currently the only company in the world offering an SMR that is based on an nth-of-a-kind operating plant.
Let's break down that phrase because it feels like the crux of their pitch to investors, nth of a kind versus first of a kind.
First of a kind, or FOC engineering risk, is exactly what bankrupted Westinghouse in 2017 with the AP1000. When you design something completely new, even if it works perfectly in a computer simulation, the moment you try to build it in the real world, you discover 1,000 unforeseen problems. A pipe vibrates at the wrong frequency. A valve doesn't seal under real-world pressure. Resolving FOC issues costs billions of dollars and years of delay.
So by scaling down the AP1000, they are telling utilities, we already pay the FOA penalty, we learned all the hard lessons at Vauxhall, and we are applying them here.
Exactly. They're entirely eliminating FO8 risk. The AP300 utilizes identical, already proven fuel assemblies. It uses the exact same instrumentation and control logic. It utilizes the identical NRC-licensed passive cooling architectures we just spent time discussing. They're simply packaging all of that proven technology into a single cooling loop and an ultra-compact footprint. The safety-related buildings for the AP300 require an astonishingly small 0.4 acres of land.
0.4 acres. You could fit the entire safety core of a 330 megawatt nuclear reactor on a slightly large suburban housing lot. That dramatically opens up the map for where you can deploy these. You could drop them onto the sites of retired coal plants, plugging right into the existing transmission lines.
Which is exactly their target market. They are actively targeting NRC design certification for the AP300 by 2027, with site preparation expected to begin immediately after, aiming for first power deployments in the early 2030s.
It makes a lot of sense. But then we get to Tier 3, and here's where it gets really interesting, almost like science fiction. We go from the 1,100 megawatt Leviathan down to the 330 megawatt AP300, and now we scale all the way down to just 5 megawatts electric. The Avinci microreactor. And literature doesn't even really call it a traditional reactor. They refer to it as a fission battery.
It is a radical departure in nuclear design. The Avinci is a microreactor, and it does not use water for cooling at all.
Wait, every commercial nuclear plant in the world uses water to move heat. If there is no water, what is inside this thing?
It features a solid graphite core block. Inside that massive block of graphite, they embed what is known as TRISO fuel. TRISO stands for tristructural isotropic.
I've seen pictures of TRISO. They don't look like traditional uranium pellets. They look like tiny little black poppy seeds.
That is exactly what they look like, but their engineering is incredibly complex. Each tiny kernel of uranium is individually wrapped in multiple microscopic layers of porous carbon, inner pyrolytic carbon, silicon carbide, and outer pyrolytic carbon.
What does all that layering actually do?
It creates its own microscopic containment vessel. Those layers can withstand extreme heat and pressure, physically retaining all the radioactive fission products inside the seed itself, even at temperatures exceeding 1,600 degrees Celsius, far hotter than the reactor could ever physically get. It makes the fuel virtually indestructible and physically incapable of a traditional meltdown.
Okay, so you have these meltdown-proof poppy seeds embedded in a block of solid graphite. But if there's no water, how do they move the immense heat from the graphite out to a turbine to make electricity?
They utilize waterless alkali metal heat pipes. These are advanced thermal transfer devices operating at extreme temperatures, over 650 to 850 degrees Celsius.
Walk me through how an alkali metal heat pipe works.
Imagine a sealed metal tube. Inside that tube is a small amount of liquid metal, like sodium or potassium. You insert one end of the tube into the hot graphite core. The intense heat vaporizes the liquid metal into a gas. That gas naturally travels down the tube to the cooler end, outside the core. At the cool end, the gas transfers its heat to a heat exchanger, condenses back into a liquid, and is drawn back to the hot end via capillary action along a wick structure inside the tube.
It's completely passive. No pumps, no moving parts, no valves to break. It's just phase change physics.
Precisely, which is why the fission battery analogy is so apt.
I try to picture this deployment model for people. You don't build this on-site with thousands of construction workers. You build the entire Vinci unit in a pristine factory environment. You load it onto the back of a standard semi-truck. You drive it out to an off-grid location, maybe a remote mining site in northern Canada, a forward-operating military base, or right next to an isolated AI hyperscaler data center. You drop it on a concrete pad, plug it in, turn it on, and you basically ignore it for a lifetime.
The design lifespan is truly remarkable. Because of the core dynamics, they are targeting an 80-plus year factory-sealed refueling cycle.
80 years. You install it, and it provides uninterrupted power for 8 decades without ever needing fresh fuel or refueling outage.
That is the engineering promise. However, as an analyst, this raises an important question regarding operational execution. We're talking about a legacy company that built its entire reputation on massive, bespoke, poured concrete mega projects. The corporate DNA is rooted in heavy civil construction. Can their supply chain, their engineering culture, and their executive leadership seamlessly pivot from building 1,100-megawatt Leviathans to stamping out 5-megawatt microreactors on an assembly line like they are building Honda Civics?
That is a massive operational leap.
Yeah.
Mass manufacturing requires precision, aerospace-level fabrication, Six Sigma quality control, and an entirely different mindset than civil construction.
That is the exact execution risk that venture capitalists and private equity analysts are debating right now. But currently, the market is assigning immense premium value to the fact that Westinghouse has engineered viable options across all 3 scales of energy demand: grid scale, modular, and micro.
Which perfectly transitions us to the next massive question. Having an incredible tech stack, beautiful blueprints, and theoretical physics models is one thing. But who is actually buying these reactors today? Let's map out the structural backlog, because all of this brilliant engineering doesn't justify a $30 billion valuation if no one is signing the checks.
To map the backlog, we have to forensically dissect Cameco's Q2 2026 MD&A disclosure. They publicly revealed a global pipeline supporting up to 91 AP1000 reactors. If all 91 of those units were built and connected to the grid, it would represent roughly 105 gigawatts of potential new generation capacity.
105 gigawatts. That is an astronomical amount of power. That is roughly equivalent to the entire electricity generation capacity of the United Kingdom, just from one company's pipeline. But as anyone in finance knows, pipeline is an incredibly squishy word. A pipeline can mean anything from a legally binding, multi-billion-dollar signed contract with a sovereign government, all the way down to a polite email from a utility executive asking for a brochure. We need to break down the conversion tiers of this pipeline to see what is real and what is just hope.
A critical distinction. Let's start with the base tier, the undeniable reality. Active commercial units. These are reactors that are fully built, actively connected to the grid, and generating revenue right now. Currently, there are 6 units globally. You have the Sanmen units 1 and 2, and the Haiyang units 1 and 2 in China, plus the newly completed Vogtle units 3 and 4 in the United States.
Okay, so that is 6 units actively prove the technology works. Then we move up to the next tier, active construction, where the concrete is poured and steel is actually going into the ground today.
That tier is currently dominated entirely by China, with 14 AP1000 units under active construction across various sites.
Now we get to a really fascinating tier, the sovereign contracted pipeline. This is where global geopolitics plays a massive, decisive role in Westinghouse's valuation. Poland has officially contracted for 3 units at their Lubiatowo-Kopolino site. Bulgaria has selected the AP1000 for 2 units at the Kozloduy nuclear power plant. And Ukraine has contracted for a staggering 9 units total, with immediate engineering focus on the Khmelnytsky site.
This Eastern European bloc represents a critical historic narrative shift in global energy. For decades, these specific countries were deeply structurally reliant on Russian-designed VVER reactors and, crucially, Russian state-owned nuclear fuel.
Which gave Moscow immense geopolitical leverage. If they wanted to exert pressure, they could threaten to withhold the highly specialized fuel assemblies those reactors need to keep the lights on.
Precisely. But following the severe geopolitical fracturing over the last few years, achieving total energy independence from Russia became an absolute existential priority for Eastern Europe. Westinghouse recognized this vulnerability years ago and successfully developed and licensed fuel assemblies that can actually be safely dropped into those existing Russian-designed VVER plants. They systematically broke the Russian fuel monopoly.
And now that they trust Westinghouse for their fuel, these nations are turning exclusively to American AP1000 technology for their massive new build expansions, completely locking out Russian technology for the next century. That is a massive geopolitical moat that you cannot replicate.
It is a definitive strategic victory. So we have 6 commercial, 14 in active construction, and 14 in the sovereign contracted pipeline. The next tier down is the FEED stage. FEED stands for front-end engineering design.
I want to focus on this because a FEED study isn't just a feasibility report. It means the utilities are spending real significant capital.
Yes. When a utility enters the FEED stage, they are spending tens of millions of dollars. They are conducting deep seismic testing of the specific site, running soil sampling, executing complex grid interconnection studies, and drafting massive environmental impact reports. It is the final, highly expensive step before pouring concrete. Currently, there are 11 units in the FEED stage, spread across Northern Europe and multiple domestic utility sites in the U.S.
And finally, we have the prospective origination tier, the wide top of the funnel.
This broad tier includes 51 potential units. For example, India has officially selected 6 AP1000s for deployment, though the final commercial terms are still being negotiated. There are ongoing high-level sovereign negotiations in Saudi Arabia and multiple large domestic U.S. utilities quietly exploring deployments.
Let me stop you on the domestic U.S. utilities. Utility executives in America are historically terrified of the capital costs of a nuclear plant. They all remember the catastrophic cost overruns at Vogtle and VC Summer. How on earth do you convince a risk-averse, publicly traded American utility to sign a contract for a new AP1000 today?
You don't convince them with engineering brochures. You convince them by utilizing the massive balance sheet of the federal government to de-risk the initial capital outlay. This is where the U.S. Department of Energy has stepped in with a monumental $17.5 billion conditional loan facility operated under the Office of Energy Dominance Financing.
$17.5 billion in federal loans. That is a massive financial catalyst. How exactly is that money deployed?
It is designed specifically to overcome that exact utility hesitation you mentioned. The loan facility is structurally targeted to fund the long-lead equipment for 10 new domestic AP1000 units spread across 5 different utility sites. The federal government is essentially stepping in and saying to the utilities, we know the massive steel forgings, the reactor vessels, and the steam generators take years to build and require huge upfront cash deposits. We will front the $17 billion for those long-lead components, completely de-risking the timeline and the upfront capital burden for you.
If we connect all of this to the bigger picture, the potential addition of 105 gigawatts of firm dispatchable baseload power globally is a paradigm shift. As we discussed, hyperscale AI training clusters demand 99.999% uptime. Westinghouse is currently offering the only scalable, licensed, zero-carbon solution that can physically provide that at gigawatt scale.
The demand is clearly there, the technology is proven, but this 91 reactor pipeline brings us right back to the central overriding anxiety of this entire deep dive.
Right. I know you listening have been screaming at your speakers for the last 20 minutes. Wait a minute. You just spent the beginning of the show explaining how building just 4 reactors bankrupted this entire company in 2017. Now they have a pipeline of 91 reactors.
Yeah.
How is this not an absolute suicide mission? How does Westinghouse avoid repeating the exact same catastrophic EPC failure?
That is the most important question of this IPO, and answering it brings us to the structural defense mechanism Westinghouse has built.
The shield.
Yes. This defense mechanism was formalized and announced on August 4th, 2026. Westinghouse executed a massive strategic alliance with Amentum, a premier global engineering and project management firm trading under the ticker AMTM across their APX technology platform.
Amentum is a giant in complex government and industrial project management. Why is this specific partnership the secret sauce of the entire S-1 filing?
Because deconstructing this alliance reveals the entirely new Westinghouse business model. It is how they prove to Wall Street that they are not stepping back onto the EPC landmine. Under this new pact, Westinghouse acts purely as an original equipment manufacturer and OEM. They are a software licensor and a critical component fabricator. They provide the highly guarded blueprints, they supply the specialized nuclear fuel, and they license the intellectual property.
And they stop there.
They stop there. They absolutely refuse to take on site-level construction risk.
So what does Amentum do?
Amentum takes on the heavy lifting that physically and financially broke Westinghouse a decade ago. Amentum leads the grueling regulatory execution and the site-specific safety engineering to fast-track the NRC design certifications. More importantly, Amentum serves as the engineering procurement and execution partner to physically scale the 1 gigawatt AP1000 fleet deliveries.
They offloaded the liability. Westinghouse has completely offloaded the complex, muddy, unpredictable site-level construction execution. If it rains for a month in Poland and delays the concrete pour, that is Amentum's problem. Amentum manages the thousands of union workers pouring the concrete, tying the rebar, and pulling the miles of copper cables. Amentum handles the endless microscopic licensing documentation at the site level. They're entirely shielding Westinghouse's balance sheet from EPC cost overrun liabilities across Poland, the UK, Slovakia, Lithuania, and the United States.
This strict contractual division of labor is precisely what allows financial analysts to benchmark Westinghouse differently today than they did a decade ago. It transforms them from a construction company into a high-margin technology provider. If you compare Westinghouse to the pure-play SMR developers in the public markets today, companies like Nuscale, X Energy, or TerraPower, those startups face a grueling financial reality.
Yeah, I look at the balance sheets of those pure-play nuclear startups, and it's a constant, terrifying struggle. They have brilliant, innovative reactor designs, absolutely, but they have zero legacy revenue because they aren't generating cash. They constantly have to go back to the public markets to raise dilutive equity just to keep the lights on and pay their engineers while they wait years for their first reactor to actually be built. It is a slow, agonizing bleed for early investors as their ownership stake gets diluted over and over again.
If we connect this back to the valuation, Westinghouse has an impenetrable financial moat compared to those startups. Westinghouse completely funds its advanced R&D. The billions needed to develop the AP300 and the Avinci microreactor directly out of the recurring plant service and cash flows it receives from maintaining 50% of the world's operating reactors.
They don't need to dilute their shareholders to invent the future. They have a billion-dollar internal cash engine funding their innovation while completely offloading the physical execution risk of building the new plants to Amentum. It is a brilliantly constructed, highly defensive corporate machine.
Let's review the architecture of this machine. You have the ruthless private equity cleanup by Brookfield that removed the legacy debt. You have the Canadian uranium supply lockup by Cameco ensuring fuel security. You have the U.S. government equity tether providing sovereign backing. You have the highly diversified three-tiered technology stack. You have the 91 reactor global pipeline driven by geopolitical shifts. And you have the Amentum liability shield protecting the balance sheet.
When you lay it all out like that, it sounds unstoppable. We have seen the brilliant financial engineering and the massive technological promise. So we arrive at the final verdict. Is Westinghouse an unassailable, clean baseload monopoly? Are there any cracks in this $30 billion armor?
As much as the S-1 filing, with its glossy charts and optimistic projections, wants you to believe it is unassailable, nothing in heavy industrial manufacturing is without profound risk. Let's synthesize the true investment case. The momentum here is undeniably historic. The sweeping electrification of everything, combined with the insatiable, panic-driven energy demands of AI data centers, has created a once-in-a-century macroeconomic tailwind for this IPO.
But we have to be rigorous. We have to outline the physical constraints that could prevent this total monopoly from manifesting. This is the bear case. This is what the X-ray reveals lurking in the shadows of the balance sheet.
The first most glaring constraint is the agonizing friction of converting paper to steel.
Right. A memorandum of understanding signed at a fancy conference or even a $100 million feed study is not a poured foundation.
Exactly. Converting those early-stage agreements into final investment decisions, or FIDs, where the utility actually irrevocably commits billions of dollars, involves brutal multi-year regulatory review cycles. You are dealing with varying national regulators across Poland, the UK, and the US. Even with Amentum expertly navigating the paperwork, the sheer bureaucratic friction of nuclear permitting cannot simply be financialized away by Wall Street. It takes time.
But from my reading of the industry analyses, the bigger risk, the one that keeps nuclear executives sweating through their suits at night, is the labor crisis.
It is the brutal physical reality of the modern supply chain. To physically deploy just the 10 domestic AP1000 units currently targeted under the DOE loan facility requires tens of thousands of highly specialized, incredibly skilled workers. We are not just talking about hiring general construction labor, we are talking about NQA-1 certified personnel.
NQA-1, Nuclear Quality Assurance Level 1. I did a deep dive on what it takes to get that certification, and it is mind-blowing. These are not standard pipe fitters. These are artisan welders who must execute welds to tolerances that can withstand extreme pressures, corrosive environments, and intense atomic radiation for an entire century without a single microscopic fracture.
And every single weld is meticulously X-rayed, inspected, and documented. The joke in the industry is that the paperwork weighs more than the reactor vessel. There is a massive structural shortage of these highly certified individuals in the Western workforce today. A generation of these engineers and welders retired while the nuclear industry was dormant.
And it's not just a shortage of people. It's a critical shortage of the massive machines needed to build the parts. The heavy forging throughput required to create the massive multi-ton steel containment vessels for an AP1000 currently does not exist at scale in the West. There are only a handful of ultra-heavy forges globally, like Japan Steel Works, capable of pressing raw steel ingots that large into the necessary seamless shapes. You can't just build a new heavy forge overnight. It takes years and billions of dollars just to build the machine that builds the reactor.
So the ultimate constraint preventing Westinghouse from rapidly rolling out 91 reactors isn't capital. The capital is eager and waiting. The ultimate constraint is atomic-level human labor and specialized heavy industrial capacity.
And that tension is the ultimate critical question for you, the listener, to ponder as you watch this $30 billion valuation hit the ticker tape. Can the gritty physical reality of pouring millions of tons of concrete and perfectly welding massive steel vessels actually keep up with the frictionless, high-speed financial engineering happening on Wall Street?
It is the fundamental tension of the modern energy transition, the speed of capital versus the speed of atoms.
So let's step back and recap this staggering journey. We have traced Westinghouse from a catastrophic Chapter 11 bankruptcy in 2017, driven by the hubris of fixed-price EPC contracts, through a brilliant, ruthless private equity restructuring by Brookfield that stripped out the risk. We examined the strategic recapitalization with Cameco to lock in the uranium supply chain. We've seen how they built an incredibly flexible three-tiered reactor stack with the AP1000, the AP300, and the Avinci. We analyzed their 91-reactor global pipeline and how they erected a brilliant execution shield by partnering with Amentum to act purely as an OEM.
All of it propelled forward by the urgent geopolitical demand for energy security in Eastern Europe and the massive, unprecedented technological energy demand of the artificial intelligence era.
It brings us right back to that X-ray we talked about at the very beginning of the show, navigating the diagnostic, muddy waters of the global energy transition. The picture Westinghouse is presenting to investors in this S-1 is incredibly compelling. It is a structural masterpiece of financial and industrial design.
But, as any good doctor knows, the X-ray only shows the bones. It shows the structure, the muscle and sinew, the actual labor, the heavy forging, the regulatory execution on the ground. That is what will ultimately determine if this massive corporate entity can truly run at the speed the market is pricing it at.
I want to leave you with one final provocative thought. We spent this time talking about traditional utilities buying these reactors. We've talked about sovereign governments heavily financing them. But if the AI baseload power boom requires this much massive capital and demands absolute, constant, uninterrupted, dispatchable energy to win the global AI race, how long will it be before a major tech hyperscaler, a Microsoft, an Amazon, or a Google, looks at the supply chain constraints, stops just signing long-term power purchase agreements, and decides to use their trillion-dollar balance sheets to buy a controlling equity stake in a nuclear OEM like Westinghouse outright? I mean, why just rent the battery when you have the cash to own the factory that makes it? Something to think about the next time you type a prompt and ask an AI to generate an image.
A fascinating proposition that could entirely rewrite the future topology of the global grid.
Thank you so much for joining us on this deep dive. We will see you next time.